Hello, everyone. Uh, welcome to. Hello, everyone. So, welcome you all to this quick explainer about today's article on the technical take, which is on the general usefulness of breath indicators and quantifying situational awareness, turning your fields into some objective rules which are very easy to act upon. So uh, that's the whole article, and that this is the video, right? So let's begin here. So why see breath, right? There are two reasons to see breath, and that is to eliminate what I call the fields, okay? And the second most important one, once you eliminate fields, is to then time your entries and exits better. And I'll explain to you what all of these things are. So first, let me explain what the field is. So, in general, you will hear a lot of traders talking about how breadth is overrated, number one, and the argument is to say that, hey, when you look at your own stocks in your portfolio, also your watch list, they are one of the earliest indicators of market breadth getting better or deteriorating, or whatever you want to see about that. And the problem in there is, I agree, first of all, yeah, that is true. um, if you have that skill to be on the right kind of stocks, put the right stocks on your watch list, then yes, looking at your stocks will also tell you about the breadth. But if you're a beginner trader, you don't know much about the market in general, then you are basically overestimating your skill as a trader, you know? Even if you're someone who's very skillful with all the experience, relying on your individual stocks and watch lists all the time is also again overestimating your skill. Now the second thing is, the problem is, fine, you can estimate, overestimate, underestimate your skill as a trader. That's very a person to person and very personal. The second thing, problem is that in there also your watch list and your number of stocks only represent a very small uh, portion of the whole market. And so there comes in the problem of something which in statistics they call it undersampling. Okay, so whenever you are trying to gain information about a large sample with a very small sample space, then you can have a lot of biases, just because the fact that the sample size is not very large. So that is a very big problem in that case. You will also see many trader say this, that squat number of squats in the market is one of the most first indicator of a market breadth deteriorating. And I wholeheartedly agree with that point. What I don't agree is the fact that just by looking at your watch list or the number of stocks you are tracking, you cannot extrapolate that to the whole market. As quick example is, for example, if you are someone who's holding pharma stocks, and if that is the case, then I believe 7 out of 10 pharma names in your portfolio would be doing better. Now, just because your portfolio is doing better, does that translate to saying that the whole market is doing better? Correct? Not the case. So that is the problem of using fields to take action. And the second thing is, like, okay, that is one thing, is knowing. And the second thing is, like, okay, acting on your fields. Acting on these fields become more difficult. How many times has it happened with you that, okay, from looking at the breadth, or by whatever means, that, okay, you feel that there is a correction coming, but it's very difficult for you to act on that. Or that, okay, right now or yesterday the markets health was getting better, and in the next 2 3 days market could now actually go up, and but you did not act on that fields, right? So all of these things will be solved if you have a objective rule based system where you can quantify the fields. Okay, then that's what I mean here by quantifying situational awareness, right? Because Situational awareness is what is situational awareness. This is something which I learned from Pradeep Bonde from Stockbee, and basically it is having an awareness of where the market is in terms of medium term trend, higher trend, and in a shorter term trend. Not just that. More importantly, let's say if you're bullish, then in which area of bullish curve we are in. Are we at the stage where the bullishness is just starting to begin, or are we at the stage where the bullishness is now in full flow, or is it where the bullishness is now starting to wane and now the bullishness is decreasing? Like which, if you can 9 out of 10 times have a good understanding of where we are in this smaller term market cycle, as a swing trader your decision making will become very easy. So the decision making is basically now this is Nitin's decision making system. Mine is slightly lesser than this, but the decisions you are going to finally make is, are should I sit out? Once you sit out and the market strength is coming back, then the question is, should I restart, like with smaller positions or larger positions at once? Can I add more? Can I go full throttle margin? Should I hold them or should I reduce? So these are the couple of things. And today the system which I'm going to show you is mostly using a 10-day moving average of the whole market, general market, right? And this is basically rather than going through the whole 1000 2000 stocks, this is what breadth is. It makes your life easier. So it's a general market wide data, right? So you've already by now if you've read the article, this is the breadth 10 which I've shared with you, and it's basically a very simple way of looking at strength. Um, so so the red line or the pink line or whatever color that is the percentage of stocks which are above 10-day moving average, and the gray line is the 5-period simple moving average of this plot. Okay, midline is basically 50. So there are three things which needs to be looked at here. One is very simply, is the plot above the 10-day or below the 10-day? Above the 10-day generally means it's a bullish regime. Below that generally means it's a bearish regime. Okay. The second one is the 10-day moving average above the 5 SMA or below the 5 SMA? Above the 5 SMA generally would mean that it's again a bullish regime. Below it generally means that it's a bearish regime. And the third thing is it rising, or is the 10 SMA rising, or is it pointing downwards? Rising means bullish, and pointing downwards definitely means bearish, right? Now, depending upon the combination of all these three kind of observation, what I do is, I basically try to answer this questions, right? And for me it's more simple. The questions which I need to answer is, should I hold, should I de-risk, or sell, should I get back in? So these are very simple questions. Okay, now so let's look at the same thing is being coded here so I will basically use this to explain this further. Okay, and you can also use the indicator in terms of overbought or oversold levels, wherein anything below 0.2, 20% is basically oversold, and that it will have a propensity to bounce after this level is hit. Similarly, if it comes near to 80% or more, then the propensity of pullbacks will be more. Okay, now do not be fooled by looking at this Nifty 500 index. These are not the real representation of breadth. And if you remember, during this period of time when indices were inching up and up, we were what the traders call a hard market environment, not an easy money environment. Okay, and that and if you had seen the breadth, you would have known that this market is not a easy market environment. Anyway, so let's get into more details about the system. Now, if the 10-day moving average is below 50, but it is sloping up and above 5 SMA, this means that the breadth is getting better, and this is a good period to get back in. So something which we are in right now. So albeit we are below 50, but the 10 period the plot is pointing upwards and now has across back its 5-day moving average. The yellow line is the plot, where the white line is the 5-day moving average. Okay, so right now, although the bullishness is not very clear in the market currently, and that confirmation comes when it goes above 50. Okay, that is not here, but right now is a period where you need to scan aggressively, look for stocks which are at your setup which you're setting up, and are at a very good a risk reward scenario. So now once the it is sloping up above 5 SMA and it gets above 50 DMA, which means that the bullishness is now for everyone else to see. It's like markets are very strong. At that time, you can, whatever you have gotten in, you should hold, or you can even add more margin, whatever kind of a progressive exposure, or whatever kind of exposure you are following in the market. So for example, this region wherein we are above 50, pointing up and still above the 5-day moving average, है ना? So till sort of this point, this is extreme strength in the market. Okay, and I'm just showing you this area, but you can imagine this area, right? Like after 6th June till about 14th June, this was extremely strong, है ना? So most of the things will work here. As soon as you take any position, most of your setups will be working during this period of time. Then there comes the regime changes, wherein the 10 DMA is still above 50, but 10 DMA now starts to slope down, still above 5 MA, but it starts to slope down. So this is a point where you should start de-risking your stuff, okay? Because this basically is a precursor to the strength in the market getting lower. So which I mean is on this day, if you see, the 5 DMA now is pointing down, albeit we are above 50 and above the 5 SMA. We know that this is a period wherein, like, the strength is now waning down, and it will not be evident if we look at the indices will still be sloping up most of the time, because indices, the momentum, the price is basically slightly lagging once we come after a bounce. Okay, so this time, and the definitive trigger of get back or scale back out from the market is this particular crossing below of the 5 DMA. Now once the plot crosses below its 5 DMA, then we definitely know that, okay, now the strength has started to wane. Whatever we were guessing ki abhi hoega, that strength is now getting to wane back. And so this position would be your time where your swing trades should have been de-risked, or and so that is this point. So once the crossback happens, we are now in an area where 10 DMA is still above 50, but it is definitely sloping down and also below 5 DMA. So this is a hard money environment. Nothing will work. Well, I mean, like only a portion of your trades will be working here. So this is basically strictly no position time. And then if everything is sloping down and we are now below 50, this is clearly bearish. Okay, strictly no positions time. So things like here right now, like these 2 days, would be strictly bearish, or like these days would be strictly bearish. But the thing is, as long more in a generally bullish regime in a medium term time frame, as soon as it also hits the 20, like the lower 20, below 20, we again go into a highly oversold zone, and then the cycle will start repeating. wherein it will now point up, and at some point of time we will cross back up its 5-day moving average, and then we again the whole thing starts again. Okay, so for a short term trader, this is a very nice way of how I look at deep breath. Now, this is not something which I have come out with. There are people who already use percentage of stocks above a key MA, and they have been using, but it's just that how you have to create your own system and look at it so many times, make observations, that now you can start trusting it. And I think I've seen this enough for me to sort of mota have a good understanding about this, and also put my trust into this. So for example, something which similar to this is stock B, which uses what he uses is instead of 10-day moving average, he uses 40-day moving average. So for example, um, so let's say 50, I mean 40 50 is very near, right? So here if you see what percentage of stocks are above 50-day moving average or 40-day, very near, and if that number goes below 20, that is what he says, that it's an oversold zone. And like for example, we were on oversold period here, we were also on an oversold period in the March low, according to stock B system. Okay, and that is what he follows. And Yeah, so that is just an example, just a quick view of telling you that this is not a holy grail. This is just a mota rule, which will sort of keep you in the right side of the market. And I have been warned a lot of times to not become so objective, and truly so, because stock market is something which we play at the edge of the possibilities, and we should definitely keep open some sort of subjectivity alive. That's where the art lies in. Everyone following the same rule will again have same kind of performance, right? So this is basically the mota system currently. And again, like I said, the more so this is just a very plain view of what I do, but there are other information which you can take from this, and that is the divergences. So for example, these two peaks were clearly diverging, so which means that price is going up and up, whereas the strength is going below, which means that we at some point of time the divergence will be solved, and that will be solved once we start making higher highs in this, or the price will start making lower highs in this. Okay, so again, we are still diverging in this time frame. And so divergences, again, divergences are not very important, or does always work, but again, divergences are also something which you can pick it from this kind of a system. Okay, so I've shared with you guys this on my technical take. Please go through that and see if it works for you, is the idea. All right. What else? Yes, so on top of that, this is a very simpler system. On top of that, you can also add now the momentum of the whole breadth, whole market momentum, to tell you even more. This is adding layers onto your decision making system. So a very quick rule about momentum is, whenever the momentum is plot is uh, pointing downwards, you just can't make money in the market. So for us to be in like a easy money environment, this yellow line should be above zero. It's basically momentum positive means that we are making money on more than 50% of the stocks, and pointing up, something like this was a period of high momentum, and this was a period where you could also have made money in the market. This you could have made money in the market. So all this pointing upwards and above zero is generally the time when the momentum in the market is high, and we will also make money. So this is additional sort of breadth. And then you can also then build up, like for example, what's the net 4% breadth looks like, and you will notice that whenever the net 4% breadth is below zero, then that's generally higher selling pressure in the market. Now, whatever I've told you here is for the short term. So for a sort of a longer term, this one you can use additional market breadth indicators, and one of the better ones are like the net new highs and new lows. So if the net 52-week high minus 52-week low is on the positive, it generally means that the market on a medium term time frame is on a bullish time frame, right? So yeah, again, I'll end this video by telling you guys that this is not a holy grail. This should not be treated as a holy grail on off kind of a system, but something which will keep you in the right side of the market and help you quantify your fields. Because especially if you are starting off and a trader who's just beginning the market, you don't have like 5-10 years of trading experience like some other people who you follow on Twitter must have, then you guys cannot be using the same kind of system in your trading to derive to a decision making point, right? People who already have 6 7 8 years of experience will look, and their fields will be better. They can still trade on their fields. But I'm afraid to say that as a beginner who's just 6 months to a year or 2 years, even I would say like 2 to 3 years is required to for you to understand what goes on in the market, and understand the market cycles broader, and the short term market cycles more. So having this would tell you a better story. So now you know that why your trades during this period of time were not working, or this period of time were not working, is because we were in a penny market environment where the breadth was actually getting weaker and weaker. The 10-day SMA was pointing downwards and below its 5-day. And if you can see, if you just plot your trades, like let's say you took 100 trades during this year, what you should do is you plot all your trades and see which of my trades which I took during this regime versus what is the outcome of the trades which you took during this regime, and you will see a vast difference. Like if in general the trades which you took here will be the win rate will be significantly higher than your trades which you took in this regime. Okay, and please do this, and I have made my mentees do this exercise and done this by myself, and have clearly seen that if you just don't trade during this period, which is basically during this period where no position, strictly no position, and de-risk, and during this period if you don't take any positions, you will inherently increase your win rate, and if you increase your win rate, you will also increase your general trade statistics, and your trading becomes better and better. So I'll leave you with that. As always, if you like the video, please subscribe to the channel, and I'll see you soon. Bye bye.